how do these Fed rate cuts actually affect us as consumers? And the reason this is so important is because although the Fed keeps cutting rates, I'm sure many of you are aware, but there's really not a whole lot of impact we're seeing. Holidays. The Fed sure did make a bit of a splash yesterday, so we will be covering the Fed press conference in our update here today. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, hopefully weed out a bit of the noise along the way. And this week's focus, although there's a few things we're going to cover, this week's focus is really based around the Fed, including a great question from that Jen actually brought to our attention, which is how the Fed rate cuts actually impact us as consumers, which we'll talk a lot about here as well. So before we get into the question of the week and I guess the Fed debrief, let's start with some of the more nuanced data. So on Tuesday, we did have retail sales. So I want to touch on that prior to jumping into the Fed conversation from yesterday. Retail sales on Tuesday were actually up 0.7%. So a huge jump in retail sales again. Which just, continues to show the strength of the consumer, which may translate to some of what we're going to cover for the Fed press conference here in a little bit. And also before I get into that, last week we had a lot of inflation numbers come out as well. And so the thing I wanted to highlight here is just to share that in general, inflation did come out a bit higher than expectations. And that will also dovetail into all of the Fed debriefing we're about to do. So let's focus on the main event here. So just yesterday, we had number one, the Fed rate decision, and number two, the press conference to follow from Fed Chair Powell. The rate cut decision was not much of a surprise. They cut rates by 25 basis points, so 0.25%. However, what was the big surprise and what really made the splash in the markets was the general tone from Fed Chair Powell, which suggested a very hawkish perspective moving forward, which is a big shift from where we've been up until this point. A lot of the conversation has been, the path is to continue to cut rates. I think in general, if I'm going to sum it up, it seemed the market and really his tone was suggesting that rate cuts at least are slowing, but honestly may even be done for a while now. So we'll see what's to come. But I think that's why we saw the market reaction that we did yesterday. What he had shared, just to kind of read in between the lines a little bit more here and give a little more context, a couple things that I maybe wanted to highlight. One is that he said to cut further from this place, they will be looking towards the economy and the labor market. So that was very interesting because in that same vein, he had shared that the risks to the labor market downside have subsided. So if the risks to the labor market downside have subsided and they're looking to the labor market for rate cuts, basically, he's saying there's no reason to cut rates based on labor market, right? Second thing he said is that they're looking towards the economy. And another thing that he had mentioned, which sounds great, but obviously the market reaction to the what this means for the Fed would kind of be conflicting. He said the U.S. economy is performing very, very well, and no reason to think a downturn is any more likely than any given period. So if he's looking towards the labor market and he says the labor market is where they want it to be, or the economy, and he's saying that the economy is very, very strong, that would suggest that really he's saying that there's no reason to cut from here. Now, those can shift quickly, right? So bear with me a bit. There's a lot of time till the next meeting. And if there's any data shifts, I would assume that they will react to that. But at least the way he had shared it in the press conference yesterday, that's kind of why the takeaway is what it is. And the market reaction was what it was yesterday. Another really big important factor to mention is that the Fed forecast for inflation had picked up as well. So that right out of the gate is what we started to see. We saw the Fed forecast come out before the press conference. Market reacted to that, and then of course, as he had shared some of this insight, continued to slide a little bit as well. Now, so far, anyways, the market has bounced back a little bit. But again, it was a very knee-jerk reaction there yesterday on Wednesday based on the Fed decision and press conference to follow. He also had shared that they are closer to the neutral rate, so another reason to be cautious about further moves. So in general, I think the market is thinking rate cuts may be slowing if not done. Markets started dropping significantly, as I mentioned, and then had bounced back a little bit. But what I will share as well is that it was very interesting to hear his perspective on the labor market. He said wants to keep the labor market pretty close to where it is. So given the concerns that we've seen looking backwards, it seems like he's feeling much more confident in the labor market at the moment. We will obviously continue to keep an eye on that because that is one of the big areas. But we see retail sales up. We hear these comments about the strong labor market. So at least on the surface, it would appear that the consumer is very strong. Before we get into the question of the week, obviously next week is going to be a little bit lighter. We've got the holiday weeks on the horizon for the next 2 weeks, so there is a lot less data to cover. But next Thursday, or coming in the next 7 days, we get consumer confidence and new home sales. But before we break here, let's touch on our question of the week, which again, Jen had brought to our attention. And it's a really important story. The question is basically, how do these Fed rate cuts actually affect us as consumers? And the reason this is so important is because although the Fed keeps cutting rates, I'm sure many of you are aware, but there's really not a whole lot of impact we're seeing to mortgage rates or to credit cards or these different types of consumer debt instruments. And so the question is coming up quite a bit lately. It's like, okay, well, rates keep coming down, but I'm still paying this really high rate. Or for those who are waiting for rates to come down to maybe buy or sell or whatever their home, waiting for this, yet it still remains to be seen. And I will share that the reason for that is because of the way that the yield curve works. And that's a lot to unpack here. So I'm going to try and simplify it a little bit. The yield curve basically describes different interest rates from short-term bonds to long-term bonds. So think about it this way. If you're to loan the government money for 30 days, you might get, generally speaking, when the yield curve is working the way it should, you might get less for that loan, right? Let's say maybe, for instance, 3%. Versus if you're to loan the government money for 10 years, let's just say hypothetically, which is pretty close to today, you might get, let's say, 4.5%, right? So in general, when the Fed cuts rates, they are cutting on the short end of that curve, in fact, even shorter. So what they are doing is they're moving the very short-term rates down. However, long-term rates don't always follow suit. And especially in a period where we are expecting inflation, we really see that to be the case. And in general, things like mortgages, for instance, are tied a little bit more closely to like a 10-year bond than what the Fed is actually controlling on the short-term side of it. Right. So when we have this inflationary expectation, I'll go back to the example I gave earlier. If you're to loan the government money for 30 days, you don't care much about inflation, right? Inflation in 30 days is not going to wipe out your return necessarily. So you're just more interested in what you get for that return. However, if you're loaning the government money for 10 years, you're very likely as an investor to look at where you think inflation may go and hopefully get a return above that expected inflation rate. Otherwise, why would you be going backwards, basically, right? So in terms of how longer term rates work, it's not just what the Fed does. That may influence it to some degree, but the market is going to price those rates, and it's going to price them based on, among other things, but inflation expectations is a big part of it for sure. So that is why, even though we keep hearing about rate cuts coming down, as consumers, we're not feeling it quite as much, except unfortunately on the things that we actually would get a benefit from, like money markets and CDs and cash instruments, right? That's where it does impact things more quickly. But things like mortgages, unfortunately, will stay higher as long as things like the 10-year bonds are a little bit higher. So for those who are paying close attention to mortgage rates, that might help you a little bit to watch some of the longer term bonds for trends and where rates could go. But that would explain why, regardless of what the Fed does, it seems that those rates are not coming down. So hopefully that's helpful. I think as rates continue to come down, that's been on a lot of people's minds. So definitely a good time to cover the subject for sure. Okay, well, we will break there. We will see you next Thursday, but that will be after the holidays. So have a great holiday season, and we'll see you next Thursday at 3.